Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are on Friday, and it's been an interesting week in the markets.
When you see dramatic and rapid changes in the directions that they take quite often on the same day, what does that tell us about the shape of the stock markets right now?
Well, the word is volatility, and hitherto, like for a year or so, you had, little hits like that, minor. So it was complacency, volatility, and there are sophisticated measures of volatility, and it was down at, well, let's say zero forever kind of thing, and then bang, it comes in. But it was classic stuff. Speculation became excessive, and I was just noting that December 19th coming up, and a year ago, on December 19th, our technical stuff came up with what we call a sequential sell on Bitcoin. And that turned out to be actually the high day. You don't often get them like that. There can be, sometimes weeks before a sell signal like that rolls over. But at the time, we wrote that was the biggest such signal in 2 years. And on that particular vehicle, and the correction on it would be equivalently serious, and actually it turned out to mark the top of that bubble. So, and then also, that was last year was very good for us, because it was on October the 4th that our pivotal events concluded that everything was going to get bubbled, including even the Dow Jones Industrial Averages. And then the next step on that research was to point out that in the past there had been a number of really good speculative bull markets conclude in the December-January window. Gold in 1980, the Nikkei last trading day of 89, and then there was the it was a very good bull market on January the 11th of 1973, and it was then followed by the worst bear market since the 1930s on that one. So the probability was, as if it got highly speculative going into December, January, it may have been an important top. And indeed it was. Because also on the New York Stock Exchange Composite, that set its high in January. Then a number of important stock exchanges set their highs in January, and indeed the index that keeps track of it all, there's a world stock index without the U.S. in it, and it also set its high in January. So they get back to the volatility now, is that the credit markets began to change in late in August, sort of September, to adversity, which was our warning that perhaps there might be a liquidity problem in the fall, and indeed we have had one, a liquidity problem. Jim, it hasn't taken down the senior indexes, but some sectors, and some of the FANG stocks, Apple and Facebook and these things, have had some very hard hits. And then I've seen a list of some junior oil stocks that have been just absolute disasters. So the senior stock indexes came under pressure, and there's sectors and individual stocks that you can say have had crashes. Now, on our work last summer when the advice was to build liquidity on strength, we use the historical, whereby when you've had a huge, what was obviously a bubble, that there's a long tradition that you can have the selling pressures in the fall, and more particularly down into late October, which we had, then a bounce, which we had, and then it's like a test of all of the selling pressures down into November, and we had that one as well. So my guess now, Jim, is that this volatility bouncing around here now is the market is very nervous, but I think the market is trying to find a bottom, a base, from which you can get a rebound. Now, the only thing I see that is risky is that the price of crude can set a seasonal low in late December and maybe even into January. So
Bob, let's talk about oil when we come back from the break.
For sure.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye, and a reminder as well, to wrap up the show, we'll have a listener question. Bob, oil, the OPEC people got together. They agreed to a 1.2 million barrel a day cut. Do they have the power to really influence prices, especially this time of year?
Only on the short term on news announcements. OPEC's been an attempt at a cartel. And 20 plus years ago, it did have a fair amount of power, but not anymore because there's so much production outside of OPEC. And so you had these guys spend 2 years with carefully calculated cuts in production to help move the price up, and it got to 77 October the 3rd. And it was in September that we thought, I wonder if the old seasonal for crude is coming back, where for a long time it would set a seasonal high late September, early October. So that came in. And then the view was that on the seasonal lows in December, January, the price, I use the term dismal price decline, or down to dismal prices. And the drop to 50 has been pretty dismal, but that's damaged it a lot. Also, it's damaged OPEC's reputation hugely, because can you imagine spending 2 years elevating the price and then boom, in a few months it gives it up. So, but there could be another shoe to drop on this thing. And then maybe in the first quarter we can have some relief to all of these selling pressures and uncertainties. But Jim, there's a probability that huge speculative peak a year ago, December and January, may have been the high for the bubble, but it's going to take a little more work before one can really make that conclusion. Our advice in the summer was to build liquidity against the possibility of a liquidity crisis in the fall. And actually, I did see a headline just the other day about disappearing liquidity. So it's been stormy. We may have some decent weather for a little while, but the risks are that this could turn into a more of a lengthy bear market. The credit markets were absolutely pushed to the limits with, it's not just stock speculators that drive equity prices up. You also, in a bubble, you also have the same intense speculation going on in credit markets, where people are playing the yield curve, or borrowing short and lending long, and these things become obvious moneymakers, and then bang, they change as well. So it's always fascinating to watch these markets. But if you look at the excesses reached, you had sentiment figures at higher than reached in 2000, for example. You had valuations against different measures higher than reached in 2000. So that shows tremendous confidence, and let's use the term ebullience. And then that was always followed by a disaster eventually. So the more speculative the boom, the more severe the contraction will be. It's just that everybody gets out there, hugely leveraged. There's no apparent risk. And then also you've got the concept that the central bankers won't allow anything bad to happen, so there's no risk there. And then at the moment of highest risk is when everybody thinks there's no risk, and then the equation changes. So, and we're watching this.
And of course, Bob, the most dangerous words you can hear are, it's going to be different this time.
This time it's different. Yeah. Yes. And we've seen that one forever. It's amazing how convictions come together and reach a climax, and then you go the other way. And then eventually, the convictions at a bottom will be the same. This is awful. Get me out. So human nature, when it comes to financial markets, really never changes, and those extremes are what makes like a top so analyzable, because technically you can measure this stuff and compare it to previous highs. Same thing at a bottom, which is actually more clear than a peak, is that at a bottom, when you reach capitulation and customers are phoning the brokers and just say, just get me out of here, I can't stand the pain anymore, that's also extreme in a crowd sense. So, and fortunately with technical measures, you can read, or as I say, the best way, Jim, is compare it to previous examples, and this makes it always fascinating for us. And then you have the game being played by the central banks, who really, they're just tag along. They react to market forces, and yet the consensus is that they make market forces. You got a record here showing that on the central bank's administered rate, which is like the Fed funds rate in the States, and then you have market rates of interest, like the T-bill rate, which trades minute by minute, second by second, all of the time. And if you go back a couple hundred years, you'll find that at major events like bubble tops, the senior central bank is many months behind the change in interest rates being set by the market. So you've got the treasury bill rate up now in the U.S. and in Canada, which is what always happens in a boom. Interest rates go up. And then what we're watching for now is that the T-bill rate turns down. Then it'd be another item that would be suggesting that a contraction is underway. But at the moment, the T-bill rate trend is still up. But what you had on the interest rate market, which was helpful in summer, as I said earlier, the change in the yield curve, which is the difference between long rates and short rates, and the change in credit spreads, which is the difference between high-grade and low-grade bonds. And they did their thing. They didn't give as much warning, like in time, as they did at the peak in 2007. But anyways, it was there, the classic pattern, the change in the credit markets. So.
Well, I'm looking right now at the Canadian 2-year 2.02, the 10-year 2.09. Is that way too narrow to be safe?
Well, it is, but on the way the yield curve, Jim, works is that the curve flattens, like the difference between the two flattens. And then in a strong economic side of the boom, it can go inverted where the short rate gets higher than the long rate. But then, as we pointed out in the summer, that the history of it, we got the yield curve back to 1850s, is that you don't need, if you're in a boom, the curve doesn't need to invert. All it does is change, reverse back to steepening. But this week, I think they're going on about the yield curve at the shorter end actually did briefly invert. So that, I forget which day that was, but it was used as an excuse to say why the stock market was down. Because some people are really hung up in the cause and effect of that thing. As a matter of fact, I've never seen at previous bull market tops so many equity guys suddenly talking about the curve when those of us who have been doing deep research for a long time have known the behavior of the curve. And so our point in the summer was not, it didn't need to invert. All it had to do was reverse, which it did do. So, but this, as I say, they used it to hit the market one day today here, where I think at the short end there was a moment of inversion, but it doesn't matter. The main thing is that spreads and the curve have reversed, and with it, it's taken some of the foundations out of the equity side of the market.
Coming up, Bob, we'll have a question from Mike from Burbank right after this.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, from Mike in Burbank. From your technical and historical analysis, do you think the 50-day moving average will hold as support for the Dow and the S&P in 2019? And if so, then will the market break that critical support in 2020, erasing Trump-era gains, or will it be off to the races again in the equity markets to new all-time highs?
Good question. That's looking at near term and the medium term and the longer term, and those are important. That 50-day is an important average, but I kind of like to use the 20-week exponential moving average, and which is very helpful. But also what we have for Mike in Burbank is some more sophisticated stuff than that with some of our proprietary stuff like downside capitulations or upside exhaustions, and then there's the sequential buys or sequential sells. Those have been very helpful. But I think we can just go from now one oversold condition where we are, and probably a relief rally, and then we've changed our model whereby it would, in a flat to rising market, it would give what we call a springboard buy, and in a rising market, one wants to buy the dips. So this was a technical trick to help buy the dips. Then we did some revision on that model, and it's now a bearish springboard where this then, in a long bear market, you would sell the rallies, and this then helps provide the right identification on a rally and when to sell. So it's a good question, but to give a comment right out to 2020 is a little difficult this time, but we can catch the swings, and we'll be able to identify when this market really fails. The market's come down, but it hasn't diminished the risk. It's on the path to a contraction, and we will be able to watch for when it gets off of the path or continues to make each step on the path. And thanks for the question.
Bob, thank you so much for chatting with us.
Yeah, Jim, good to be together, and we'll look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. You can forward questions to Bob or for any of our other guests to info@HowStreet.com, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.